Hello again. It's time for another interest rate update. It's March 2025, and I am Trevor Carlson, the president of Heritage Reverse Mortgage. If you're watching this, you're probably on our watch list, watching what interest rates are doing. And the good news is things are moving in our direction. We did have a rough few months as interest rates climbed from September to about January. But since the middle of January, interest rates have been sliding, and we're down about 0.6%, which is pretty amazing. In a 6 week period, to have that much of a decline in interest rates is fantastic. To get right to the point for most of you to be able to benefit from lower interest rates, we still need them to come down at least 1 to 1.5%. But again, with this kind of momentum, you could see how that could realistically happen within a 2 to 3 month period. And we'll talk about some of the factors that are playing into the market right now that I think will be key to us hitting those targets and being able to improve your life and financial situation. And so suffice it to say, if you want to cut off the video now, interest rates are coming down. We'll get another update out to you next month. But if you're interested to see what's going on, stick with me for another minute and I'll kind of talk about the market and what's happening and why I'm so confident that we are moving in the right direction this year. Now, if you've watched some of my videos before, to understand what drives interest rates are a function of the strength of the economy. When the economy is strong, interest rates have to go up to slow it down from getting too strong. And when the economy is weak, interest rates have to come down to get the economy going again. And that's why we're seeing this massive volatility in the market, is because people can't decide, is the market strong, is the market weak? The stock market says it's strong, but the consumer says it's weak. And so it's just this back and forth of who's going to be right. And so let's talk about some of those things. The most common thing that we talk about with interest rates and what's driving them is the Fed, the Federal Reserve, because they have direct effect on the Fed funds rate. Most people think that they're the ones that actually control the economy, and they indirectly they do have a strong lever in the Fed funds rate. In that if they lower the Fed funds rate, that makes it easier for banks to borrow money. That makes banks more profitable, and they can then put more money back into the economy for the consumers to use in the form of car loans, credit cards, and student loans and those kind of things. When the Fed is trying to determine how strong the economy is, they look, number one, at inflation. If inflation is hot, they have to raise interest rates to bring inflation back down. And that's what we're seeing. The inflation shot up a couple of years ago. The Fed raised their Fed funds rate super high, and now we're seeing the inflation rate get lower and lower, but it's struggling to go below where it is. The caveat to that is that the Fed has said that they also don't want to kill employment. And so if they're fighting inflation, trying to keep it down with higher interest rates, but the the end result of that being that people start losing their jobs and the unemployment rate starts to go up, then the Fed may change their tune and say, okay, that's enough. Let's bring those interest rates back down and get the economy going again. And we're starting to see more and more of that kind of talk from the Fed, because unemployment is becoming more and more of a concern, especially now that we're seeing, arguably one of the largest employers in the nation, our government, is starting to cut so many jobs. That could have an influence on what the unemployment rate does over the next few months, and that could influence the Fed's decisions. But let's talk about the economy, because the story you get from the news and reality are not always the same. I would argue that the economy is a lot weaker than they're telling us. For example, if we measured unemployment today the way we measured it in 2008, we wouldn't be around 4%. We'd be closer to 7 or 8%. And that would be a major shift in economic policy. Other things that I'm watching are bank liquidity. Our banks have less consumer deposits than they've had in a few years. And this is concerning, because if the banks have less money in liquidity, then they borrow less money. And another thing that I wanted to show is this graph that I'm bringing up now. This shows the delinquencies over the last 90 days. And you can kind of see there's been a big spike in things like credit card delinquencies and auto loan delinquencies, as big as we've seen since 2008. Now, the big difference here is that remember, 2008 was a recession caused by real estate, and there's a massive, delinquency in mortgages. We're not seeing that this time around, but we are seeing those delinquencies in auto loans and credit cards, and that points towards a weaker consumer, less spending, and a harder time for people who are trying to survive from month to month. Likewise, another thing that I'm keeping an eye on is weakness outside of the U.S. Our major allies and enemies outside of the U.S. are starting to really struggle and pointing more and more towards recession. China's in a very difficult situation financially. The European Union likewise is not doing great. And so as America's policies become more American-centric, that could weaken those economies further, and that could drive a global recession that would cause some changes in Fed policy. Now, if you've heard the term quantitative easing, this is something that the Fed did in 2008 and multiple times since then when the economy got really, really weak. Essentially, the Fed turned on their printer and they started pumping cash into the economy in the form of lower interest rates. And if we have a major upset in one of these areas that I'm talking about, there is a very real likelihood that the Fed will do this again. They'll turn the printers back on. They'll start pumping cash back in the economy. And that gets us into a whole nother discussion of what happens with interest rates and inflation. But the point is that, this movement we've seen in interest rates over the last month could be just the beginning. Now, time frame wise, I don't know. I've been trying to predict interest rates for my entire career of 20 years, and I'm terrible at it still. But from what I can see is that if we continue the movement we're on now, really by summer of this year, many of you could benefit by resetting your mortgage to lower interest rates, to either reduce your payments or pull cash out, all around just making your life better and making it easier for you to deal with the inflation that's hurting us. Historically, however, usually when we see major market events, it almost always has happened in third quarter or fourth quarter of the year, meaning between September and November. That's when Black Friday happened. That's when the Great Depression started. I could go through the list of major economic downturns in history, and they almost always happen between September and November. And so every year, those are the months that I kind of hold my breath to make sure that that's not happening again. But anyway, rest assured, we're watching this. If you have questions, of course, let us know. But we'll keep updating you on a monthly basis. And if you're not on our watch list already, please shoot me an email or give me a call. Let's get you on the watch list so that you don't miss out. Because when those interest rates do start hitting those target interest rates, there is going to be a flood of refinancing happening, and you don't want to get stuck at the back of the end of the line. And so make sure that you have somebody, us or somebody, watching rates for you so you can take action and move forward as soon as that opportunity arrives. So again, looking forward to talking with you and helping you. Call us at 435-359-9000. You can email me at trevor@heritagehl.com, and we're looking forward to helping you. We'll see you.